Book value per share is a financial metric that represents the value of a company's equity available to shareholders on a per-share basis. It is often used to evaluate the worth of a company in terms of its net assets and can provide insights into the company's financial health. This ratio is particularly useful in comparing a company's valuation to its market value, which can be helpful for investors looking to assess whether a stock is overvalued or undervalued. Unlike profitability ratios or liquidity ratios, which focus on earnings or short-term financial health, book value per share offers a snapshot of what shareholders would theoretically receive if the company were liquidated. Book value per share. To calculate book value per share, you first need to determine the company's total equity. This is obtained by subtracting total liabilities from total assets. Next, divide this equity by the number of outstanding shares of common stock. This provides a per-share value based on the company's net worth. Essentially, it reflects what each share would be worth if all assets were sold and all debts were paid. Example: imagine a company has total assets worth $1 million and total liabilities of $600,000. The company's total equity would be the difference, which is $400,000. If there are 100,000 shares of common stock outstanding, the book value per share would be calculated by dividing the total equity, $400,000, by the number of shares, 100,000 shares. Therefore, each share's book value is $4. This means that, theoretically, each share of the company represents $4 of net assets. Low book value per share. A low book value per share might suggest that the company's stock is undervalued compared to its net assets, especially if the market price is significantly higher than the book value. This could be due to several factors, including declining profitability, higher debt levels, or market conditions. It might also indicate potential issues with the company's financial health or management. High book value per share. A high book value per share generally indicates that the company has a strong asset base relative to its equity. This can be a sign of financial stability and a solid foundation for growth. However, if the book value is significantly higher than the market price, it might also suggest that investors have lower expectations for future earnings or growth. How can companies optimize book value per share? Increase asset efficiency. By enhancing the efficiency with which assets are utilized, companies can boost their total equity. This could involve investing in higher return projects or reducing operational waste. Reduce liabilities. Paying down debt or refinancing at more favorable terms can improve the equity position, thereby increasing the book value per share. Retain earnings. Reinvesting profits back into the business instead of paying them out as dividends can help grow the equity base, leading to a higher book value per share. Key takeaways. Book value per share is a valuable measure for understanding a company's financial health in terms of its net assets. It offers a straightforward view of what each share would be worth if the company were liquidated. A low ratio may indicate undervaluation or potential financial issues, while a high ratio often signifies strong asset management and financial stability. Companies can optimize this ratio by improving asset efficiency, reducing liabilities, and retaining earnings. Understand the value of each share based on net assets. A low ratio can signal undervaluation or potential issues, whereas a high ratio indicates strong financial health. Optimization strategies include increasing asset efficiency, reducing liabilities, and retaining earnings.